So I'll kick this off with the basic economic outlook. Thought this was working. There we go. Oh, a little bit on the introduction for the day. So as I mentioned, I'll look at the economic outlook. It's relatively good, more recovery coming. But then I felt that one of the burning issues of today, I think, especially over the last year with the publication of Capital in the 21st Century by Thomas Piketty, that the income distribution issue has now become a front burner issue. Okay, there was some kind of observations in the past over the last decade or so that things have really changed a lot, and this may impact the way we think about economics. And I think that's really become clear over the last year. So we thought we'd have somebody come in and talk about that. And the Washington Center for Economic Growth, Equitable Growth, Washington Center for Equitable Growth is a relatively new think tank in town. So I felt maybe we could go and see what they have to say on this. The third item is the BEA, as Doug mentioned, industry data. And we felt this was really important from our perspective, at least, because this is the raw material that we use for our work. And we are daily in this data up to our elbows. But we felt that it'd be very interesting for you to see about this, and most of all because some important and interesting new things have been happening with this data set over the last couple of years. So you wanted to hear about that. The fourth item there is healthcare. So as you know, healthcare is a big front burner issue as well. We do a lot of work in this area, and we've got several interesting contacts. Thought we'd pull those in to give you an idea of what may be happening from here on out, so the future of healthcare. And then finally, we wanted to highlight a research project we did for the National Association of Manufacturers over the past year concerning infrastructure and infrastructure investment, public infrastructure investment, and the benefits to the economy. So that's kind of where we'll go for today. Okay. So to start with the economic outlook, the question now is, can we leave the Great Recession behind? Are we finally going to see a buoyant recovery, a recovery that sustains at 3% over 2 or 3 years? That's what we need if we want to close the gap between, as we'll see, the GDP potential, the potential of the economy, the potential of workers, and where we still are today. Okay, and for now, there's a lot of good news out there that we'll talk about. So the signs are looking pretty good. Domestic demand is pretty strong. One of the bigger question marks over the last couple of years is housing. We expected, because it hit such a trough, because it was so far down, that housing would have a little more bounce than it actually has. Now, we know last year the weather during the winter actually took a lot of housing activity out, but the surprising thing, perhaps surprising, is that it has bounced back even from that bad quarter a little less than we might have thought. So there's a question there. Another things, when we look abroad, we see trade could perhaps be slowed down by even a deflationary environment in Europe and even troubles in Asia. The other point is, and we'll talk a little bit about that, is the dollar exchange rate. The dollar's been strengthening, and that may ding trade a lot, but we don't see that as overwhelming the domestic momentum. But remember, the danger from abroad is not so much through trade. I mean, if your customers are a little bit down this year and you sell less there, that's something that you need to roll with the punches. What usually happens, though, when you have a crisis, the contagion is felt through financial markets. And also, these days, security-wise, we've got a lot of question marks, whether they be in Ukraine, in the Middle East, and so forth. And so those are the threats are more the financial linkages with the rest of the world, and then the security linkages. Okay, quick overview. As we said, growth is stronger, okay? So the red lines are the year-on-year GDP growth rates, which I really kind of prefer. This does work. Okay, you can see that first quarter of 2014 on a quarter-over-quarter basis. was quite a shock, okay? So we had a big chunk of negative growth that's been primarily attributed to a lot of bad weather, okay? Bad weather happens, it could happen again, but there's a bounce back from that. But yet, you know, last year at this time we were hoping, well, I guess we had a 2.6 forecast ahead with a little bit more momentum. Now we're going to come in at 2.2 or 2.3, something like that. A little bit disappointing, okay, and certainly not the buoyant recovery that we would hope for. Okay, oops, wrong way. Okay, so there's, if you look at it vis-a-vis potential, so we fell, and this is the potential from a year ago, and Bob just let me know that they updated it two days ago, but I imagine in the short term it's not a heck of a lot different. But yet we were 8% below potential, and we've been climbing slowly back to what we call the potential. I'll talk more about this a little later, but where we think the economy should be in terms of GDP. And I put on a couple extra years to show you that you know, the pace will quicken a little bit, but even at the end of 2016, we're still going to be about 2% lower than where we think the economy can be without a lot of inflationary activity. Okay. Okay. Now, I always like this graph because I think this gives a big picture perspective of employment, although it's kind of hard, to notice what all the excitement is about. But that little blip on there of a year of rapid growth, relatively rapid growth compared to all this, is, you know, the 220, 300,000 a month new jobs that we have seen. Okay, so suppose this number would get above the 2% for a whole year, maybe 2 years, then, you know, the great American jobs machine is back in business. Okay, without that rapid growth, then we're still going to be kind of bumping along at a 2% level, which I call sideways. If you think that GDP in the long term can grow at 2%, and we keep growing at 2%, despite being the fact that we're 4% below potential, we're never going to get there. Okay, and people are going to remain very unhappy because we won't be pulling the people that have left the labor market in and so forth. So hopefully we'll get more and more performance there. And one of the things that we look at is the JOLTS, as the BLS called it, which I guess is the Job Openings and Labor Turnover Survey. Okay, and these are very interesting to see. I took these directly from the BLS site on this. One of their indicators is the number of unemployed persons for job openings. Okay, so obviously during the recession, that got pretty ugly. Okay, 6 unemployed people for every job opening. Now we're back to 2, which, as you can see, is really kind of a normal rate. Okay, maybe we'll get a little bit below 2. Things will be looking better. Okay, but it's a good sign. The other good sign is the employment is the green line. The payroll employment is green line. The blue line is the job openings. And you can see that over the last year or so, there's been a surge. You know, we were kind of moving along, very volatile series. And then all of a sudden, the job openings took off. Okay, and if you kind of look at this, the blue line is definitely a leading indicator of the green line. So another good news story there. One of the things we've talked about in the past is the falling participation rate in the economy. And we've looked at this in detail and actually changed some things around in the model to make sure we've got this right. But the story kind of goes like this. So the participation rate, which unfortunately I don't have the overall here, but you remember it's plummeted from 2007 to now by about 6 percentage points. I may have the dates wrong, but something like that. And, you know, that's quite a bit of a fall of the participation rate. Well, if you did dissect that, quite a bit of that, at least, well, around half is what people are saying, is just people passing from the 25 to 54 age bracket to the 55 plus. So these are the baby boomers. So as you can see, the participation rate of people in the middle age, the prime earning years, is much, much higher at about 80, okay? And then as they move to 55 plus, that falls down quite a bit, okay? So a lot of that participation rate is something that really was anticipated in the past, and we knew about it. It'd be nice to keep the baby boomers working for a while, but you know, that's expected, that's what happened. But the other half falls in the actual participation rate, especially at the top. Now this doesn't look like a lot, but from 2000 to 2013 now, this fell by about 2. Okay, so 2% of those, that big prime earning years, fell out of participation. We've got a lot of participation rate falling for the younger cohort as well. Now some of that is people staying in school longer. If you saw the 16 to 19, same thing. People, instead of working in high school, like most of us did, they're all taking AP courses and studying late at night. That's our story. We're sticking to it. But even at the 2024 range, okay, the rates of college entry are not up a heck of a lot, maybe graduate school, but that's also fallen. So a lot of this is fall of participation rate in cohorts. And one of the things that we hope is that as the job market's much better, we can pull some of those folks back. Okay. Now, in the end, okay, here we are in December 2014. We are still in the inflation, what we call liquidity trap position. Okay, we still have 0% interest rates, and we still have very, very quiescent inflation. Okay, so this is still the big story. No matter what we're seeing on growth, we still have this potential deflationary problem. Okay, now, given that things are looking much better, that might be not a source of concern. You can say, okay, things are looking good. Fed wants to raise interest rates, and we'll maybe get back to a normal situation where interest rates are positive. Inflation is much closer to its target of 2, maybe a little bit over, because we want to see some wage growth. But when we look at Europe, you know, they're in much worse shape, okay? So inflation's much lower. Interest rates obviously are right now, yields on German debt are lower than US debt. So the deflation that we might worry about is more in Europe now. So I'll talk a little bit about that later. Okay, so but the good news keeps coming overall. Energy production is helping to drive growth, okay? Even with the oil prices falling, there's still a lot of investment in the pipeline. So the big stimulus at the beginning comes from drilling wells, building pipelines, and so on and so forth. There's still a lot of that in the pipeline. Now, oil prices might knock that down eventually, but for now, it looks okay. Now, the second part is oil prices are falling. So this is putting a lot of money into the consumers, extra money in the consumer's budget, okay? Something is happening in healthcare, okay? So we'll talk a lot about that this afternoon. Okay, we see Obamacare came along, and you know, its primary objective was to get people insured. It seems to be doing that. Now, it also seems to be pretty complicated and costly to administer. Okay, so that's something that could have been anticipated. We don't know the long-term effects of that. But Obamacare or not, as we'll see, something is happening that seems to be reducing both the utilization and the prices in healthcare. And we'll look at that in detail this afternoon, okay? The fiscal situation is stable, meaning that we're no longer reducing government spending. Okay, I'll show you that. And a lot of that's because states, some, not all, but many, many states and localities have less pressure on them, okay? Financial markets seem to be more in tune with the Fed where they are, okay? Expanding employment will have positive spillovers, especially in housing. As I mentioned, housing is a question. Jobs is good for housing, and so private business is still sitting on a lot of cash. So that's all good news. Okay, so Now I'll do the outlook a little bit, show you some numbers, but those of you that haven't been here before, I'd like to set the context in a sense that we do this annual outlook, and actually we do a semi-annual outlook, in the context of our lift model of the economy. And the reason why we like to have an outlook and then present it to folks for feedback is this becomes our baseline for a lot of the experiments, scenarios, and things we do for various sponsors over the course of a year. Okay, so one of the things we want, so this is kind of the model, and there's a lot of moving parts in here and so on and so forth, but one of the things we want is for the real side, the economic growth side, okay, all the way from population participation rates to assumptions on productivity, to be consistent with the nominal side. So you can't just have lots and lots of growth and not pay attention to, for example, the trade balance in dollars, the government deficit in dollars, and so on and so forth. So we want those nominal balances to become sustainable over the long term. So it's a lot of, that's what, you know, a lot of fitting in is to get both the real side and the nominal side together. Okay, so, and I'll show you that. And this forecast, we usually, these days we go out to 2040 in case somebody needs some kind of scenario that long. Okay. So here's our overview for the coming year. We're at about 3% growth, okay? Similar to what the blue chip is saying now. This year, at this point, the model has 2.2, so the numbers are looking at 2.2, maybe 2.3 for the year, which is actually will end up being an improvement over 2013, but still kind of the same old story. What we really want to see is 3.1, then 2.7, 3.1, 3-4 years of good, solid growth, because if you do that, you can, I'll show you the unemployment rate in a minute. Okay, driving this growth, of course, is the baseline of personal consumption. We're still going to be hoping for decent growth in residential, in housing, so on and so forth, better investment outcomes. Actually, I guess this year we're going to have about 7.1 equipment and the intangibles. So next year at 6.4 is actually a downgrade, but still not a bad rate. Exports, we're still pretty optimistic there, even in the long run. And then again, I mentioned, you know, the government's kind of been deflationary the last 2 years, actually last 5 years going back, and now they're going to be benign, you know, so it'll be about a zero. Very, very low inflation still, okay? So it's the base on the... Okay, here's the supply side, so especially relevant in the long run. So we think population, that might be on the high side of some folks' estimates, but a little bit less than 1%. Labor force a little lower in these inner years as we start retiring. Employment growth, still not 2%, but anything that's 1.5 or something like that is good because the labor productivity is there. Okay, unemployment rate, which has come down a lot faster than we expected over the last year, at 5.6 next year, and then eventually converging to what we think is the kind of the natural rate. Okay, interest rates go up, and then this is the nominal consistency that I talked about. Okay, so you may not buy this, but at the federal net borrowing is actually, it looks flat, but as a percentage of GDP, of course, that's following. So anything under 2 or 3% is pretty sustainable, and the current account as well, almost balanced by 2030. Okay. Again, good news. Deleveraging pressure for the household is lower, so the debt burden is lower. So, and we can see people are buying stuff. Here's the average price of regular gasoline, so we've got some good news there. But this is at about, still, you know, a little less than $3. I just filled up the other night at $1.03. So I've actually bought 30 gallons of gas at $1.03. Of course, that a lot of dividends from Giant helped me out there. But so once a month, my wife and I empty both vehicles and take it and fill it up. And so I had to take a picture of $1.04 gas the other day. So So that's putting a lot of new discretionary income in people's pockets. Okay, motor vehicle sales, not looking too shabby. We're back to the 16 million figure. Okay. Housing starts, again, are inching upward. Okay, everybody kind of agrees that the 2 million mark was a bit excessive, bit of a bubble, but you know, something in this range between 1 million and 1.5 million would be healthy. You know, one of the problems that we've had, I mean, that's kind of retarding the growth is household formation has been quite low. As you know, the joke at every one of these economic outlooks is, you know, how many you have, you know, 20-something children still living in the basement or in their bedroom, and people have just not had enough earnings. Even if they're working, the earnings are very, very low relative to the costs. Now, we did just launch one child, and he got his first job, and he was very bullish that he had all this money to buy furniture and a TV and all this type of stuff, and I was just saying, boy, you know, you just don't know. You know, do your budget. Of course, I make my children do a budget and a worksheet, everything like that. It still wasn't showing up. I think he's got a lot less money than he thinks. Okay, the Federal Reserve. So where are we on monetary policy? So now the Fed is no longer buying bonds on the open market. So as of October, that ceased. Okay, so they still have the big balance sheet, right? So, you know, if this was the history of the assets they kept on their spreadsheet and then they on their balance sheet. Sorry. The laser is too close to the switcher. Okay. So quantitative easing, okay, this is QE3 pretty much. So a big ramp up in what they own. So now they're stuck with this on their balance sheet. So they can't just go ahead and start selling stuff, okay? They're going to actually probably hold on to this quite a bit. And I've read an article recently that, you know, they may be a tool of their own, okay? So now that they've got all this federal debt on their balance sheet, if we did get into an inflationary situation, the Fed would say, well, this is a good opportunity to go ahead and dump some of this back on the market. But, you know, as long as we're at that zero interest rate, low inflation situation, they might just go ahead and hold this. And then the question is, what happens when that debt matures? What do you do? And there's really nothing stopping them from saying, you know, just rolling it over, okay? Now, again, in an inflationary situation, that's not the best thing to do. But as long as we're still facing weakness, we don't really see the Fed doing anything with that. That's the other thing. But now the discussion is, do we get a rate hike? Is it June? Is it July? That type of thing. So we're guessing that if the momentum, especially in the labor market, keeps up, that we'll see a rate hike before July. Okay, maybe a quarter point. I think the consensus is by this time next year we'll be at 0.5. So they're not going to ramp up too quickly. Again, the prices look pretty quiescent, especially with oil prices coming down. So it may be a while. Again, the main economic threats come from the financial market. So the Fed may get involved closely watching what's going on in the Eurozone and even China. Okay. Now, the Fed also has a very big job in developing the regulation for the new regime under Dodd-Frank or whatever might have to be. So you know, a lot of people are saying that there's still credit constraints for small businesses, for some consumers, and that a lot of this is due to the new regulation. Okay, so that's a fair point. And the question is, you know, how much of that is prudent and how much of that is wasteful, okay? And that's a question that I can't answer, and the Fed is probably trying to look into how to streamline the regulation to make the banks safe, but at the same time get capital to the high return, maybe high risk, but higher return types of businesses. Okay. On the fiscal policy side, okay, so this graph is fiscal policy. It's real government spending. So the total spending, federal plus state and local, transfers, consumption, investment, the whole bit, divided by the GDP deflator, okay? And this is quarters from the recession trough. So we have the different business cycles. The blue one is the 1982 recession, which was quite steep. The brown one is the 1991 recession, and the the red one is the 2001 recession, and then the current one. Okay, so we see that in each of the previous recessions, government spending was expansionary. So the government, whether that was through transfers or military spending in the 80s, and state and local, not really retrenching as much. All those other recessions, fiscal policy was expansionary, whereas in this past one, it was negative. Okay, so that's the one thing when we look back and say, you know, how did this recession go relative to others? And we could see a big policy difference there. Okay, so maybe that's why the monetary side had to do much more. Now, the good news from our perspective is we can see that government spending is rising. Real government spending is rising. Once again, 3 straight quarters. Okay, big risk on the out is not so much this coming year, but sequestration is threatening to rear its head again this time next year. So 2016, we may see a big fiscal contraction again. Okay, at least from the federal side. Most of this good news is because the state and local ones are spending money again. Okay, not all of them, but many. Okay, and you can see that the employment recovery after recessions somehow mirrors that line. Okay, oil production. So you've heard it before. We actually went through 30, 40 years of fall of both petroleum and natural gas production in the country. Most of us in, say, 2005 were convinced we'd never see that turn up again. And, of course, it has quite a bit. The history here kind of flattens out here, and then it's, you know, it's down, 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 down. This graph is to show you that we've changed our assumption a little bit over the last year. The AEO 2014 base, now when you say 2014, that means the annual outlook, the EIA, the Energy Information Administration, issued about a year ago, okay? And they had the pop up and then kind of a fall down, but not such a large pop, okay? Now in our spring forecast, we kind of followed that trajectory, okay, and then flattened out. Now last year also, the AEO had the high resource case. So this is the case where the production, they make an assumption where the production is the highest, and you can see that that gets quite large. I mean, this is in million barrels a day, so that's at 12 million barrels a day at a time when the U.S. is probably consuming only about, what are we down to, about 15 billion there, or a million barrels a day at that point. So imports really displacing a lot of imports. We're not that optimistic yet, but our current forecast is the red line. And so we're optimistic that this is going to ramp up and stay there. Now, there's a little blip. 2014 is, I think, a little more historical. But we do see it rising next year. Like I said, a lot of this is already in the pipeline, despite the prices. Of course, this is sensitive to the price. Okay? So we may be wrong here in the short term, but we're confident in the long term that the fracking is going to stick around. Okay? Healthcare, just quickly, we wanted to point out that for another year, so CMS released the historical data on national health care expenditures. I guess it's been almost a month, a couple weeks, something like that. And as it turns out, for 2013, okay, the growth of healthcare expenditures has remained at a historic low. As a matter of fact, I think it was the historic low. And that's the blue. Do I have this all? I thought I updated this. That may only, wait. In any case, the point being is, for many, many years, healthcare expenditures in nominal terms outgrew GDP, okay? So that's why every year you see healthcare expenditures as a percentage of GDP rising, 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 rising. But surprise, over the last 5 years, okay, it hasn't really risen. The healthcare has grown at about the same rate of GDP. So that curve flattens out, okay? Similar, as Steve will show you this afternoon, similar to what it did for a period in the 90s, okay? And I guess we have that period in here somewhere. Yeah. So we had the big inflation and then coming down. So, you know, we got a similar period, okay? So something's going on. Have we bent the curve? Well, so we'll hear a lot about this afternoon, but surely a lot of it is just income-related, recession-related. As people lost their jobs, as people lost their income, they went to the doctor less, you know, as they lost insurance and so forth. So sure, a lot of that is in there, okay? But, you know, people are pointing to other things. So, you know, cost sharing gets a bad rap among non-economists. Whereas what we're saying is if the actual consumer paid more for their health care, they would actually be better consumers and shop around, and health care would cost us less, okay? And among the 10,000 professional economists, this is a very popular notion. Among the public, I'm not so sure that they like that. But what we do think we see is that higher deductibles, higher copays is actually part of this drawing down of the rate of inflation of healthcare. And going forward, we're just going to see a lot more of that. So, and some of that is promoted by the ACA, but much of it really predates the ACA. Generic prescription. So there's been out of those components of NHE, you see a big part of it is prescription drug costs, both the volume, but especially the price, okay? Now, is that going to last forever? So we'll hear some ideas this afternoon. So a lot of structural changes, different types of things are going on that is contributing to this slowdown. So where that goes from here, though, is hard to tell and kind of important. On one hand, you have healthcare as a stimulant, okay? So in a otherwise underemployed economy, if you're going to give people insurance, well, they might use that insurance, and so we'll have an expenditure level that's quite higher. It may stimulate the rest of the economy. On the other hand is that, you know, that health care eventually, once you get to potential GDP, is going, if you want it, it's going to elbow out something else. So you can only have so much health care without taking away from consumption of other goods, okay? So that's an important aspect. So where we are. So the economy is poised to grow faster in 2015, okay? But it seems to me every fall we hear this, right? Every fall for the last 4 or 5 years, it's been a tough time to be an economist, right? So you see all the problems wrought by the Great Recession. I mean, now we're going on 7 years, that's a big chunk of even my career of covering the Great Recession, okay? So it hasn't been the greatest of times. But it seems to me that each year going into the new year, we have a lot of optimism, we have a lot of momentum in the figures or the indicators and so forth, so we want to grow faster, okay? But I'm starting to feel like Charlie Brown, whereas there you are a year later and you say, well, you know, the economy didn't grow as fast as we had hoped. We're still at that 2% level. So that's why I put there, not again, will it happen? So take it with a grain of salt. Again, we got some risks. The security risks. You know, the one thing that about the bad weather last winter that was somewhat unique is it was one of the few, very, very few times where you see weather or catastrophe actually have an impact on GDP, okay? Even Hurricane Katrina, some of the other big disasters we've had over the time, the damage was significant, but it was localized. It never became a macro event, if you will. Whereas the weather last winter, because I guess the time frame, it lasted a long time, where people weren't going to work, construction wasn't getting done, it actually showed up in the figures. So we can't rule that out, okay, but maybe at a small probability. Higher probability is the economic weakness in Europe. The dollar could strengthen, okay, sharply. There's a couple factors here. We'll talk a little bit about that. Maybe I'll defer those comments. Inequitable growth. So again, I think that this is a real issue. That's why we have a speaker today. How much that's going to affect us in the short run vis-a-vis the long run. I think that's speculative, although it certainly is something we need to put on our radar screen. The divided government creates uncertainty and gridlock. I don't think Congress wants to mess around with the economy too much right now because things are going so good. But again, next year the sequester is in the law, so they're going to have to come to an agreement to avoid the sequester again. And I don't know if you've all noticed, but there's kind of a labor problem going on in the West Coast ports. This was documented by a report we did for the National Retail Federation and National Association of Manufacturers on the economic impacts if this port strike actually occurred. Okay. Now this isn't, well, maybe you could put it up there in those man-made catastrophes. To become a macro event, it has to last a long time. Okay. But you know, it's out there as well. Okay. Here's the growth that we use to drive our international model, and therefore LIFT is taking off of these growth rates in terms of trade and so on and so forth. Okay. And actually, you know, we like to, probably what I should show you is the inflation rates in Europe, because that's a lot more alarming. But we actually see a quickening of growth in many countries. I mean, France is going to go from almost no growth this year to 0.8 next year. Germany is actually going to slow down a bit, but Italy, finally, after many, many years of negative growth, will stay the same. Spain is recovering a bit, UK. So not so bad in the baseline, not so bad. Japan, you know, 1% growth, not so good. In the long run, you see, we've decelerated China probably more than most folks, okay? So that's where we're looking. So the baseline doesn't look horribly bad. It's more the same for Europe, very slow growth, but it's not a renewed recession, okay? But yet, when you do look at the inflation rates, there's reasons for concern. Now, this is where we've changed something as well in our forecast. So for many, many years, we always felt that the rebalancing of the world economy implied that the dollar would fall. So that's this is the reserve currency index. So higher is a stronger dollar. In this case, the Fed flips it from the normal. So the higher this number is, the stronger the dollar. And of course, the stronger the dollar, the less competitive your export industries are and your import competing industries. So for years, we always felt the dollar would depreciate gradually, and this would facilitate the rebalancing in the economy, especially vis-a-vis China, but also a little bit vis-a Europe and the rest of Asia. Okay, so this would stimulate our real exports. Now I'm coming around to the feeling that we're looking at more like the period in the 90s, where the world was looking to the U.S. as the demand locomotive, and meaning that they'll be happy to lend us money as long as we buy their stuff, and that the dollar will strengthen. I mean, we've already seen the dollar strengthening the last couple of years, and for good reason. Slow growth abroad. Okay, the energy revolution here not only sucks in capital, but decreases our current account balance, so the dollar appreciates as well. And on top of this nominal appreciation of the dollar vis-a-vis what we used to say, okay, so now it's more or less flat, as you can see, okay. That's a 20% difference, though, by 2030. So it's not trivial, okay. In addition to this, on real exchange rate terms, since our inflation will be faster than in Europe, the real exchange rate is going to appreciate even more than the nominal, okay. So this does create a little bit of a problem for especially manufacturing, people that export a lot. Okay, now, so I said, well, what is our export outlook vis-a-vis? And I gave you the big, broad historical aspect. The blue is what we used to say. The red is what we're now saying. So it's not going to knock exports growth off of the charts. We're still going to have strong growth, as I showed you, but it's a little less than what we used to think. So manufacturing will be a little smaller at the end than we used to say. Okay. Another thing I wanted to point out is, and Dan and Don know I've been harping on this a lot, and I think it's going to be an issue you're going to hear about, is does this energy revolution, a new surplus in energy exports perhaps, at some point we may sell more oil and gas abroad than we're importing, okay? But of course, the net has been falling, okay? So that's one thing that tends to push up the exchange rate. But also, all this capital investment that's going into energy is increasing prices for the goods that go into that investment, like steel and construction equipment, but also machinery and so forth, okay? So the real exchange rate is appreciating against these folks, and that is what happens with Dutch disease. So you could have industries, not on a macro sense per se, we might not see it much in a macro sense, but you could see individual industries that aren't invested in the energy revolution that suffer because of the real exchange rate increase. And this was a study that Don Norman and I did for the Aspen Institute, and so we looked at what happens in this particular case, what happens if we start exporting crude oil, okay? So if we remove the ban on crude oil, you'll have investment flowing to the oil industry, okay? Production will increase, and that really does help the U.S. grow and produce higher incomes, but to the extent that it, and so how's that work? Okay, so capital expenditures, if you're the machinery sector, which is in our case 6 sectors, you get a lot new capital expenditures, $4 billion in this case from exploration, $2 billion from production and so forth. The refining actually fell for a technical reason I don't need to get into. So there's a lot of positive stimulus in the black for machinery, okay? But also exports fall, okay? Now you can see the net in this particular case is still quite positive, but that's because these guys have a big stake in the actual investment. If you're electronics or Boeing, if you're Boeing, for example, that don't have any, don't really have horses in this game, okay, you're just looking at a fall in exports because of the real exchange rate appreciation. Now, given my development economics background, my instinct is, I've seen this many, many times, this could be a big deal. But the more I work with the model in this, I'm saying, yeah, the U.S. is very big. It's very diverse. So while you can see it showing up, it doesn't become something that we need to worry a whole lot about. But if it does happen, just remember you heard it here first. Okay. The long term, okay? Let me move a little quick. Oh, by the way, I wanted to do a little bit of a advertisement. So last Thursday, a week ago, the Cato Institute had a day-long forum on the future of economic growth. And one of the questions, really the main question they wanted to get answered is, are we in a new era of secular stagnation? So it wasn't so much focused on this year, next year, or whatever, but the long term. Where are we going to go? And you know, the people like Dale Jorgensen and Robert Gordon have been very pessimistic, okay? And in this particular forum, I think they had very compelling arguments to show that, no, you know, potential growth is not 2%. It could be as little as 1.5, 1.6, 1.7, which I find very, very low, but it also is very different than what most people are talking about. So unfortunately, I keep looking to see whether they have the video of the conference posted. They do not. But what they do have is a forum with something like 50 or 60 eminent economists in there that talk about this question. So follow that link, and you know, I think if you're interested in economic growth, the long term, it was very, very eye-opening for me. There wasn't just the pessimists, though. There were optimists there that feel even what we'll show is the 2% is understating the potential growth. Okay, of course, you know, we're all crystal ball gazers. Nobody has. Well, actually, Bob Shackleton is the one that produces the official, the baseline. Everyone talks about their forecast relative to his. So it's good to know the master of the potential growth. But the point being is, here's the trajectory of real GDP. Okay, what we used to think is the green line. So this was our potential GDP forecast in December 2007. Okay. Now what we see is this slowdown here. Now, I think this is a little bit misleading. If you read Bob's paper carefully, much of the slowdown of what they think of potential GDP is now, correct me if I'm wrong, Bob, vis-a-vis what we might have thought 7 years ago, is just that the trends that predated the recession, when you look at those trends again, that probably the green line was somewhat unjustified, okay, especially demographics, right? So 2007, we were overly optimistic, and it's basically because Bob wasn't doing it then, right? Somebody else was doing it. And they did it wrong, or you know, they used their judgment, looked like the data was well, but when you reevaluate those trends, the blue line is better. But some of this is what we call hysteresis as well. So we've lost a lot of capital investment over the last 7 years. So you have less capital, you're going to have a lower GDP potential, and that's the blue line. So this is the current potential. The red line is our forecast. So here we are at 2014. I think that's 2014. So like I said, about 2% low, so that's about 2%. And then we converge by about 2020, you can say, oops, we're fully converged. Okay, oh, so what's that mean? You know, I noticed that the people, Larry Summers coined this word, secular stagnation, but people are using it for a lot of different things. It doesn't mean slow potential growth, I think. It means growth that is chronically below potential, okay? Chronically below potential. So we've had a lot of that in the recession, okay? This is the total loss. The blue line is the total loss versus the green line, the old estimate of potential. The difference between the two lines is the difference between the old potential and the new potential. And the red line is the difference between the current forecast and the new potential, okay? So the fact that we're operating below that is secular stagnation. But the fact that we now think that we're going to grow less, now this probably overstates the hysteresis because, as we mentioned, maybe about half of the difference is just mismeasurement of trends previously. But you can see that we've lost a lot of potential growth just because of the recession. Okay. Marshall will talk about this later. Just to point out that, oh, thank you, Peter. Just to point out that inequality just isn't showing up in income and wealth, but in other areas as well. Everyone's doing better, but some people are doing better than others. In this case, a fraction of students completing college. Between the end of the baby boomers and their kids, it's gone up for everyone, but it's gone up much more rapidly for the top quartile. Okay, so it's not just income. There's a lot of areas. And does income equality discourage growth? I had this one last year, so we'll talk about that. I talked a little bit about this last year, and today we'll have a presentation. Okay, debt check, where are we in terms of debt? So another thought about what could impede future economic growth is too much federal debt. Okay, currently, as of September 30th, debt held by the public is at 74%. We're back over 100%. And the total debt, that includes the trust funds. Okay, so that's the 17 trillion, almost 18 that people throw around. But of course, here's the 18 trillion that people throw around. And here's the total liabilities. If you throw in the unfunded liabilities for Medicare and Social Security and pensions. And that's at 62 trillion, which sounds like a big number, but it's only 6.3 of the cumulative present value of GDP. So 6% is probably a big number, but it's not a catastrophic number. 2 years of growth. Okay, tax reform. So one of the things that could really help the potential would be tax reform. How we go about this. You know, economists have a pretty good blueprint of really to move away from income tax, move away from a tax on factors, capital and labor, and towards consumption, right? Whether we'll ever get there is another question. A couple things we could do right out is, as you know, my pet peeve is the tax deduction for employer-provided insurance. That's up to $200 billion a year now. Mortgage interest deduction, phase that out. Okay, and you could use those closing of loopholes to lower and flatten the rates on the income tax. The tax rate, the corporate system needs to be overhauled, if not eliminated, and so on and so forth. Okay, more energy taxes can replace that. One of the, I'm trying to remember, one of the commentators on that Cato forum that I mentioned had mentioned that, you know, what he would do is eliminate the corporate tax and replace it with a big carbon tax. And that may be a great solution to that problem. But anyway, it'll be interesting to see whether this actually gets real traction on the Hill over the next couple of years, whether tax reform is really in the cards in the form that would make a big difference. Okay. Let's see. I think there's our government projection. Okay. You may not buy that, but it's convenient from our standpoint because if you by the way, our expenditures are a lot like CBOs, but we raise the taxes in the model to cover them, okay? Because if you don't, and you have that exploding deficit that CBO has, it creates a lot of mischief in the model. And you get out to 2025, 2030, 2035, things start getting crazy. So the model says, I don't understand this world where you can borrow forever. So you either have to tax or reduce expenditures. Now, the expenditures don't grow all that fast, especially outside of Medicare by the outer years. So that's a big aspect, okay? But the nice thing is the federal debt as a percentage of GDP falls. So I think I'll stop there and ask for questions. Yes, Bernie?
You touched on this in your reference to the Cato forum, and I didn't hear it, so. But one of my concerns on this long-term outlook, one of my concerns on the outlook for the long term, you seem reasonably positive on that. My big concern has been our lack of investment in infrastructure, and that over time, that is what will has the potential to lower growth, to lower potential growth. We see deteriorating highways, water systems, and we just go on that. Are you of the belief that we will put the money back in there, or haven't thought about that? Or so what's your views on that?
So you'll need to stay for the last presentation of the day where we treat that comprehensively. I think it's an important point, infrastructure. You know, one of the things that we try to do with this project that you'll see this afternoon was, you know, all the civil engineers say the infrastructure is horrible, okay? All the repairmen and people that depend on trucking, so, oh, these highways are terrible, terrible. A lot of economists weren't all that convinced, frankly. They say, well, we don't see it in the data, okay? Well, they didn't look close enough, and so we'll show that. You know, frankly, the 2.3, so it all shows up in the productivity end, and so what we would do is the alternate scenario. It's kind of hard to show, though, or it's difficult to find how infrastructure affects productivity in concrete ways. Now, that said, we did it in this other project, so we'll show you that this afternoon. Yes, Dan?
Jeff, you showed hysteresis. I guess, what is the definition of that? My understanding is the lack of investment in the past leads to slower growth in the future. Is that true?
Yes.
Yeah. So I guess my question is, we are seeing lower investment, private investment in those last several years, and is that due to like a negative a negative accelerator effect for investment, or the effect of investment? Is it the accelerator effect that is working in reverse, as you have a slower potential growth rate in the future that you have? It's bringing down investment more rapidly, or is it some other reason? So, you know, it's a good point. And it goes both ways, so it's not even linear. It's really a circular system. So what we say is, you have a recession, which is bound to affect investment anyway, okay? But coming out of that recession, okay, one of the things, the accelerator works in the following fashion is even though I haven't invested in a while, now I have to investment just to replace the stuff that's wearing out, and then that hits the economy, and people say, oh, I got better business, so I need to lay in more capital, and you have that virtual circle coming out of the recession, which traditionally has been paced by investment using the accelerator, okay? In this particular case, I think that the output fell so bad and the outlook was so uncertain is that, you know, even people with investment to replace didn't do it, okay, or they couldn't get credit to do it, perhaps. Certainly in housing, that's true, okay, and then that was almost a reverse multiplier, okay. So this particular one, because it was the leverage, you know, Carmen Reinhart idea that financial crisis is different, okay, and longer, the recessions after are longer because of the financial, that aspect had a bigger impact on investment in this case than we've seen previously. And instead of that virtuous multiplier, you had a negative. And, you know, on the other hand, too, is it not was just the private sector, but the public sector was affected as well. Because really the first thing that happened on the fiscal policy was the state and local had to cut back, not just on physical infrastructure, but also education and so on and so forth. So you had kind of a unvirtuous circle working for a while, and we've been trying to get that stopped and reversed all this time. So in the meantime, you've lost all this investment that we would have had otherwise. Now, how much of that, it's
it is speculative. You know, how much is hysteresis? It's speculative. And frankly, you know, our old potential growth rate in the 20s and 30s was at 2.3 as well. So we haven't brought down our total growth rate, or our long-term growth rate, but we brought down the level of GDP, the level of potential because of the loss in those 7 years. So if you look at that blue line, where is it? I guess the other way to look at hysteresis is you look at the slope of the blue line, okay? So during the recession, the slope flattened out. And then once we get to full employment, then it's going to be a virtuous circle again. So I guess hysteresis, the other way to look at it is the blue line, the slope flattening. Nasir?
Hi, Jeff. This is Nasir Chinchi, U.S. Treasury. It's always good to come here and enjoy your forecast, outlook. And it raises a lot of issues, and you cover a lot of them. Basically, I have some questions that you may be able to ask.
We always do.
About one or two, because there's so many, but I'm just going to concentrate on a couple. One of them has to do with the outlook overview that you have, and especially if you look at 15, 16, going to 16, 17. You know, my age is showing. I can't even read anymore. But anyway, you go from 2.7 to 3.1, and then you go back to 2.5. And the question is why? Probably you rely on investment and so on. But the question is, why that particular year? So that's one question. Let me ask you the question, and you can answer them collectively, if that's OK with you. The other has to do with the R minus G question, and that has to do with the Piketty story here. The interest rate versus the growth in the economy. Basically, what you show in the long run, interest rates heading back to 5%, which they've normally done in the past. But unfortunately, as you've shown, the growth outlook for GDP in the long run is in the 2% range. It's no longer at the 3% range. And as you probably are familiar, CBO and others have re-examined that relationship between the 10-year Treasury rate and the potential growth rate of the economy, and they've adjusted downward their 10-year, their forecast for the 10-year Treasury rate in the future. So how come you're going back to 5 when most of the people are considering that theoretical relationship between growth and the interest rate? So I'm going to stop there and let you answer those. Thanks.
Yeah. I thought our Treasury rate was about the CBOs, wasn't it? Oh, okay, and then in the long run. Okay. Okay, so I wouldn't, the first question, I wouldn't put a whole lot of stock into the fluctuation, okay? A lot of that's the quarterly patterns. So a lot of this 3.1% growth is really due to growth in this year, right? The year over year. And if you think next year be somewhat uniform, it's going to blip down a little bit. And I think that's in each one of the components. So one of the things you do need to worry about when you look at the growth rates in the intermediate term is the growth rate this year really matters a lot for next year. So I wouldn't put a whole lot of stock in that. I would think of that in general, we're saying 3% growth for 3 years. If we get that, that'll be fabulous, okay? Okay, on the interest rate thing, I thought we were going to pull this down. Okay, we are back at 5. So, Bob, are you guys down at 4? Is that in the long run for the Treasury, the 10-year? So the 2020 number, I think, is the CBO's number. Yeah. Now the RG thing. So I'm in the middle. Let's put this one aside, and let me say this: I'm in the middle of reading the book. It's never been quite clear to me, and maybe Marshall can help us. And I haven't gotten to that part, I don't think, whether the G he's talking about is nominal or real. Okay, that's what's been it's nominal. Yeah, that's what I thought. So 5% interest rate, 4% GDP growth is not a big difference. Okay, But that's what I thought. It was nominal. Okay. Any other questions? So, yeah.
What are you seeing for the regional economy? It seems to be lagging the national.
Okay. Well, right. And I think the quick answer to that one is the federal government. Okay. So I get asked this question a lot. Why is Maryland, why is Virginia not growing, really? Not growing over the last 2013. There was negative growth in Virginia, flat growth in Maryland. And the reason was the sequester. Right? Actually, 2013, you had two hits. You had the shutdown of the government, and then you had sequester. Okay? So in 2014 ain't much better, even without the sequester. So, you know, we lived through a period from about 2000 to 2010, 2011, where the federal government in this area increased spending by nominal terms, but still 7% a year on average. Is that about right, Mark? Is something like that, federal spend? Of course, we lost that data as well, so that data is hard to come by. But when we had it, it ramped up quite a lot. And of course, as the federal government contracted spending, it contracted here. So that is really, I think, it in a nutshell. And even if, you know, you figure that federal workers haven't had a raise, they had one raise in 5 years. And even the state workers had one raise in 5 years. So if people's incomes are stagnating, you're not going to get a lot of bump. And so this is a real challenge going forward, I think, in this area. You know, we had one of our county supervisors down in Virginia out at a scout meeting, and he was talking to the scouts, and somebody asked him about sequesters about a year or so ago. He goes, oh, you know, I don't worry about sequester. It'll have an effect for about a year, and then after that, it'll be just like old times. And I was about ready to think, no, you guys need to wake up. The gravy train is over. Any other questions? So good. Okay. So we'll take about a 5 or 10 minute break. I think there's coffee and everything, and then we'll get on with the next thing. Thank you very much for your attention.